Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today on the podcast, we have Aleksey. Aleksey advises limited partners on existing and future deals. He writes weekly to 7,000 investors on his LPs, limited partners and investors platform. And he also helps general partners on matters related to LPs. Prior to this, Aleksey ran Store Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. Thanks for joining us, Aleksey. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, thanks again for having me. I think you gave a decent intro, but I guess to put it simply, if an LP has an existing investment, I help them think through that if there's a decision to be made. And then I also help with any future deals as well that they might be contemplating. And then I sort of, I guess a year and a half ago, I started lplessons.co, which is the newsletter, which is now actually up to like 8,500 subscribers, which is crazy to say. But yeah, I mean, that's sort of meant to help educate people. And then at some point, just more recently, which is like 2 months ago, I don't know, I guess at some point I realized like there's only so much education I can give to people, and probably the best education is just showing them stuff. And so that's what prompted me to start GP-LP Match, which is a totally free platform for like GPs to send deals and LPs to receive deals if the deal meets certain filters that they put in.
Nice. Well, I appreciate what you do. I think there was a lack of knowledge base in for LPs and kind of jumping into deals. And there was a few years ago a sense of FOMO, and they didn't do their research, and people did very well because the market was doing well. But obviously that has changed since, and so it's more important than ever. So glad to have you on. How did you start getting into the business of helping LPs?
I think the only answer is I just started. I used to be in like the public REIT world, which is very different than the syndication space. Like the capital flows there are just vastly different. And I honestly just sort of like stumbled on GPLP economics, habits, like things that happen in the industry after I left Store Capital, which was the public REIT where I was. And I don't know. I don't know how else to say this, but I just felt like there's like way too much to do for relative to how much is being currently done for LPs in the space, especially when you consider like the amounts that are being deployed per year. And so I basically said like let me do something about it, and I just started.
Well, nice. And that is a question we get a lot. What's the difference between like a REIT and a fund? And I'd love to hear your thoughts on that.
Yeah, well, the first thing is probably liquidity, right? In other words, typically there's public REITs and private REITs, but here I'm going to assume that you're talking about public ones. Public ones, you're basically just buying a share of stock. in a publicly traded company, just like you would buy, I don't know, Tesla or something, not investment advice. And at any point you can sell it, right? So I think the biggest change is liquidity. And I think another big change is like focus, mandates, right? One of the beautiful things about REITs is I think they're generally run more efficiently because they're managing more assets. Um, but they might not have sort of like the specific investment thesis that you're interested in, right? So like the big upside with private syndications, whether it be funds, but even more so single asset ones, is like you get to see what you're investing in, you get to ask very specific questions. Whereas with a REIT, you get the benefit of liquidity, but the problem is you don't really like, you're not sitting on an investment committee, you know what I mean? So to speak, on before investing.
And is it fair to say REITs typically have a lower return profile because they're mass buying and higher fees for a typical investor? Is that true, or is that not true?
REITs have lower fees, you said?
Well, lower fees and a higher return profile typically. Maybe it's safer because you've got many more deals in there, but the target is maybe more like an 8 to 12% IRR versus a projected profile of, let's say, 15 to 18% with a fund,
Right.
a typical real estate fund or a syndication deal.
Yeah, I mean, I'm usually very careful to like compare things across IRRs because, as you like very well know, IRRs like are baked half the time. In fact, I have like an entire article on this topic. That it's like extremely dangerous to focus on IRRs and like filter deals using that metric. Same with cash on cash, by the way. And look, generally speaking, public companies tend to invest into more core type assets. Historically speaking, core type assets return less than non-core type assets because the latter are more risky. But of course, if you sort of like segment by a few years and not look at a long enough horizon, then there will be exceptions to that. But overall, yes.
So I'm curious, what are some of the key metrics that you focus on? Obviously, yeah, IRR can be easily manipulated, and it's strictly projected. So what are the key things you look for?
There's a lot. There's a lot. I think. Um, I guess I'll summarize them in buckets. I like to think of syndications in what I call it is the three pillars of LP investing. Um, the first and second kind of have nothing to do with the property, which might surprise people, but I think the property itself is actually the least important um, in syndication specifically. So that's third. The first one is the execution pillar, which is, do you trust the GP? Do they have the experience to execute? Have they done this before? All types of things around that. And the second pillar is alignment of interests, which is a mix of the co-invest, any fees that are being charged and at what junctures, and the waterfall as well.
I 100% with that statement, and we talk about that in a book I wrote called Invest Smart, because you are betting on the jockey, and you've got to do your due diligence there. Don't chase IRR or chase bonus depreciation, because at the end of the day, that's where you get burned, and a lot of people do that. They say, oh, it's a high number, but it's a made up number. There's no guarantee, and so you really got to bet your money on the jockey.
Yeah. But also I would do like some people go too far in that direction too. In other words, they're like, oh, like they have 100 million AUM. Half the time, by the way, that AUM is a lie. But that's a whole other topic. But like, they have 100 million AUM on their deck, and like the deck is so nice. And my friend invested in it, and they got their distribution a month ago for the first time. So clearly, it's like legit. And they all of a sudden take their whole like the whole 401k and dump it into there. So I've heard crazy stories, Gary. But yeah, I mean, I agree.
It's good advice. I'm so glad to have you on because investors need to hear these things because it's so important. It's you're taking, as an operator, you're taking their hard-earned money, and I don't care even if it's as little as 25,000 to someone that's still a lot of money that they worked hard for, and you've got to have a tremendous amount of transparency and fiduciary responsibility when you're taking that money, and unfortunately, that always isn't the case. And LPs don't know how to vet deals and sponsors correctly.
Yeah, I would generally agree. And I always tell people that, like, if you don't have, like, either your experience in the space and you've done investing, um, or you're not, right? First of all, the step number one is figuring out which one you are and be like self-aware. If you're not, you basically have two choices: either stay out, right, or educate yourself, right? And both are fine. Like, no one's telling you that you should invest in this stuff, or at least I'm not going to. Like, it's not so bad to, like, put your money in the S&P or some index, right? I don't know, like treasuries are earning 4% now. It's not terrible either, right? So like, there's no fire under you. Um, and if you're not ready, just don't do it. I don't know, like,
What are
otherwise
some
you're
of the
just
biggest
like, you're like sorry, you're gambling while thinking you're investing, and that's like a big problem.
Yeah. And people do that in the stock market or with oil and gas or in all different asset classes. And this is no different. What are some of the biggest mistakes that you've seen over the last year on the LP side and even on the GP side?
I mean, I'll start with the GP side. Obviously, like, it's not the happiest of years in the past 2 years, not the easiest either. I think I've said this for a long time, and I'm just going to continue, like, repeating myself. Like, capital calls are like a normal part of this business. Um, it's a really bad idea to say you never do them. In fact, I think it's like almost like it should almost be illegal to say those words, because you're basically saying that, like, we will never make a mistake, we'll never have an issue, and if we do have an issue, like, who's the first person you should call? Your partners. They might decide not to fund, in which case you get a third party or whatever. But so I mean, I think that's the biggest, and maybe a very relevant point therein is just communication in general. Like, I don't know if I need to say more. Like, just be honest, transparent. But that's tough during bad times. It's much easier during good times. Um, on the LP side, look, like circa 2021, 2022, by far the biggest errors were cap rate compression assumptions, crazy refi assumptions. All of that is like unwinding itself. Um, Nowadays, I think the things that I'm seeing is, there's a lot of, like, refi assumption traps, like, meaning people might be assuming reasonable entry and exit cap rates, um, but there's like a refi in between that gets you 100% of your capital back, and that refi assumes crazy numbers that might not be realistic. I think that's like the biggest one now, and you know, um, there's the phrase called loss to lease, which is sort of something that describes how much you could raise rents at a multifamily property. Um, and I think that used to be a theme. Like, I'm buying this property, and I'm going to raise rents, and that's the value add. Nowadays, many markets, like, are having rents drop, and so this is another area that I think many LPs are getting caught on today, is they're not realizing that, like, not only should the assumptions not be 5% rent growth, they should be negative. Meaning when the existing lease rolls, the new tenant will actually ask for a discount. Um, and I mean, that's like weird thing for people to wrap their head around, but it happens.
Yeah. And rent growth is a huge factor in that projected IRR when you're looking at that. That
Yeah.
and your your sale cap rate, your reversion cap rate. These have massive effects. And so yeah, if your rent growth went from 5 to 3, which is great still these days, that'll have a huge effect. And certainly most markets over the last 18 months have at best, maybe have gone up 1%, and most likely in a bigger market, and a market that has had massive rent growth has gone quite a bit negative. I mean, things bounce. What goes up comes down some, over time somewhat. And when you've had
Exactly.
massive supply come to market, there's some absorption, but it takes time to go through. And hopefully, maybe towards the end of this year, where we'll start to see, getting back up. We've seen kind of like a U curve of like our rents have come down and they're kind of going back up to where they were. And hopefully we could start pushing rents over the next few months. But yeah, with
Yeah.
expenses increasing, and lower income, it's been really hard for many operators.
Yeah. And look, I hope all of that is true. Right? Like I think it's logical. It's just like I think LPs forget that rents can go down, cap rates can go up, right? And like it's really important to understand what you're getting into from a risk perspective. I just find that LPs spend way too much time getting excited about the upside, which to be clear is like very important. If the upside wasn't there, you wouldn't look at the deal. That's fair. But like they spend almost no time understanding the downside. And I think real estate is not, you're not like putting seed money into an investment that might 100x. And so probabilistically speaking, like you should just not be taking that much downside risk in real estate investments. And it takes time to look through that and understand it and ask questions.
Yeah. You mentioned capital calls before, and certainly there's been a bunch over the last couple of years. What advice would you give a GP that needs to do one?
Yeah, I mean, I guess there would be a lot of different things. To just keep things simple, I would just say, like, be honest, right? Like, you'd be surprised how difficult that is, or how uncommon it is. Maybe that's a better phrase. Be honest and transparent. Honest means like just don't be sleazy, right? Like I don't know, like present what you're trying to do and be honest. Be transparent about what the uses of the capital are going to be. Um, and I think just maybe put it together. Like I think GPs sometimes forget, just in my humble opinion, like they're so busy trying to find new investors that they forget about existing ones. And that's part of the business to some degree. I recognize that you have to diversify your LP capital base, but like at the same time, you have to remember that like your best investor is your existing one, right? And if they're finding out that your deal is distressed through a friend or through a colleague, and they're investors in it, like that's not great, and especially if like the most extreme case, which happens all the time, like you know you've been in a deal for 2 years and you get all these like positive updates about dog parks and the holiday party picture and all these things, and the LP just has nothing, no reason to assume anything is going wrong. And then all of a sudden you get an email that says, hey, you have 2 days to fund this capital call or this thing is going to foreclosure. It's like, what? Like, like, how can you expect anyone to fund that? Like, you just lose all the trust. And in some cases, like hundreds of people that would invest in many of your deals, even if they knew about the foreclosure. Like, things happen and people understand it. It's painful, right? But like, if you explain the situation and what you've done and what you're trying to do and be transparent, I think that's the that's the best path, just in my opinion, at least.
Yeah, yeah. Um, you've gotta say the issue that whatever it is, how are you gonna fix it? What's your plan? B, C, and D. Um, it as a GP, it's hard to relay negative information, but it's every business every property you have is business, and you've got to be able that no one expects everything to go perfectly. There are times that
Yeah,
there are struggles like in any business, and you've got to be able to communicate that.
exactly. Yeah, which is exactly my point. Like saying things like we don't do capital calls is nuts. It's like, how do you know your business won't struggle? Like, I don't know. Like, I'm a partner with you. I want to know if something is going wrong, right? Like, you just be honest with me. Like, if you need more money, I have money. Just like explain to me why you need it and why it's a good investment for me, and I'll invest more. I don't know. Like, I mean, it's not rocket science. It's just it's hard to deliver bad news.
Yeah, but I think it's certainly in some cases contributing to a capital call, because there have been two deals that I invested as an LP, and I just said no because I didn't. There was no clear path to making that money back, or I could put in
For sure.
40% and it was like maybe a 50% chance I get that money back. And I just didn't like the odds when I saw it. So you've got to understand, yeah, the odds on like if you do put in this money, what are the results that you could reasonably expect?
Right. And I think it's went back to like GP capital call advice. In my opinion, it's like crazy for a GP to assume that the LP will do that math, right? Like meaning you have to provide that. Like part just like you pitched the LP to invest in the deal, you now have to tell them like, hey, we screwed up, slash like, maybe we got surprised by rates, it happens, right? Um, and here's where we stand. Like here's how your investment is worth nothing today. Just want to be clear. But like, here's why we think you should plow another 50% in, and why it's worth it for you. You don't need to invest it in the stock market. There, you'll get the 8% or whatever it is. Here, this is a realistic path to getting more than 8%, right? And here's what's going to happen to your original investment, and here's what assumptions we made to get there. Like Gary, like this is like what I just described sounds so simple, but it's like 1 in every 50 capital call emails.
Wow.
It's like it's very rare, extremely rare, and to the point where like I would say 50% of capital call emails don't even tell you what will happen if you don't invest. Like something that basic. Like, do I get diluted? Do I not get diluted? Is there a penalty? What is it? Right? The docs are usually not clear on what happens, but even if they were clear, like you just got to tell people, they're in the middle of like a surgery or whatever it is. You know what I mean? Like they might be on their boat, and you got to like help them make a decision.
Yeah, and for any typical investor, understanding the docs is hard. It's a lot of pages. It's a great if you're having trouble sleeping at night, read like a PPM because that will certainly help you. The legalese is just brutal. All the ways that you can lose money in a deal and just trying to understand it is hard. But it's a
Yeah,
necessary thing for an LP and as a necessary thing for a GP to recommunicate those important points as well.
precisely. Yeah.
Yeah. What are some of the things you'd like to see in an investment deck that you rarely see
Can I say an address?
for the property?
Yeah, like I don't know, like 50% of the decks that come across my decks don't have an address. I mean, I'm kidding, Carrie, but like, sorry, I'm not kidding about the 50%. That's actually true. But like, I'm going to tell you something more valuable than an address. It's just like, don't forget about the simple stuff. I think the most valuable thing to an LP is understanding that you, as a GP, understand the risk profile of what you're getting into, right? And the idea of GP LP relationships is like the LP is the capital, the GP is the pro, and they're presenting a thesis. I think part of any investment thesis is like, hey, if something goes wrong, here's what you can expect. In my opinion, that's just the sensitivity table. Like if cap rates go against us, if interest rates go against us, if the refi doesn't work out as we expected, if the exit doesn't work out as we expected, if rent growth is not 5% a year, here's what happens. And again, how many decks do I see that have that? Maybe 25%. Right now, here's the crazier thing. I advise LPs, and sometimes I'll tell them to request it. And I think 50% of the time they come back in like a week, which to me, like I don't want to overstate this, but it's like a little bit scary. You know what I'm saying? Like how can you put hard money down into a deal, not understanding what will happen if some things go off the rails? You know what I'm saying? Like your your compensation is behind the LP. You're not going to collect your promote until things go the right way. So how can you like put a deal together and go under contract without knowing like how sensitive this deal is? Otherwise, you might work for 5 years and not make anything. That's crazy.
Yeah, 100%.
Sorry, I'm done.
Yeah, you've got to really we analyze something to its death. It's because we want to make sure all these little manipulations, expense growth, income growth, cap or exit cap rate, your interest rate, all these factors. It's like we have a massive spreadsheet that it's just so important to really know your deal inside and out. And before you try to bring in investors and whatnot. Yeah.
For your own sake. Forget about the LPs. I would just argue like for your own sake. What could be worse than working for 5 years and making your LPs, I don't know, 10%? So they're sort of happy, but like you like basically came out with nothing in your promote. Like that sucks. No one wants that. I hope.
Well, I do think some people get their super high fees from the very beginning and whatnot. So
yeah, I mean, that's another 30 minutes, Gary.
Yeah, absolutely, absolutely. So I'll ask you one more question. Any other like key advice that you would give to an LP, and maybe it's certain criteria that you've seen in the best performing operators or deals to invest in? What golden piece of advice would you give to LPs?
Meaning, what is the common denominator of the
Yeah.
best decks that I see? I think just like thoroughness. Like you can tell if something got slapped together in a day. I mean, at least I can. I mean, like I ran a 20-person team. We produced like I don't even know how many decks per week. So it's like when I open a deck, and by the way, this is why I mean jokingly, somewhat jokingly, I wrote an article called "Deal Flow Rules the World." And it's like for LPs. In other words, the only way for you to learn like what's normal, what's not. Like don't sit here and listen to me. Don't listen to anyone. Just like look at 100 deals, and you'll see. Like you'll see that like a 30-70 split is not normal. You'll see that a 10% acquisition fee is not normal, and you don't need anyone to explain that, right? Once you see the options in front of you. So I think thoroughness is the biggest thing. Like you can tell when a deck is very thoughtful, when there's like sensitivity involved. You can also tell when there's errors, right? And that's just I think that's it. It's like you can tell when someone really cares and really thought about something.
Yeah. And like you mentioned, the reps too. By looking at enough deals, by doing this enough, you're going to learn what's thorough, what's not. And so that's really important. Like anything, the more at bats you have, the better off you're gonna be in it.
Yeah, that's the idea.
Aleksey, thank you so much for coming on and really sharing your wisdom on how an LP should look at deals. Please tell the listeners where they can find out more about you or even subscribe to your newsletter.
Yeah, newsletter is lplessons.co, co at the end. I mean, you can find me on LinkedIn and Twitter. I post every day. If you want to submit a deal to GPLP Match or join and get them, that's gplpmatch.com.
This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.